Welcome back to Mag Strategies, Mag Wealth Training Reading Strategies. And today we're going to talk about long call options. It's another strategy, be strategy number three. The first one being just buying stocks, holding them, and watching them go up in value. The second one was the dividend ETFs. Hopefully, you guys are doing fairly well with those. And this is strategy number three. This is just the long call option, using very little money to not own the shares, but just control them for a period of time. So we're just going to go ahead and get into how that's done and why. Here we have my saying, I had every reason it to fail, but I chose none. So let's not fail. Long call option strategies. Simply explained, a long call is one of the most basic and powerful bullish option strategy. When you buy a call option, you're paying for the right, not the obligation, to buy stock at a set price, which is also known as the strike price, before a certain date or expiration. You're buying it because you are bullish. Bullish meaning you believe the stock is going to go to the upside within the period of time that you're purchasing it. So you want the stock to go up. What you're going to get is the right, not the obligation, to buy the stock at the strike price. Strike price is generally what the stock price used to be. And we're going to go over some terms when we go into the practical. Your maximum risk will only be the premium you paid. The premium you paid will only be the maximum risk. So therefore, your loss is going to be limited. Your profit potential will be unlimited because as long as the stock price keeps going up, so does your potential profit. It's best when you expect a big move upward and you want cheap upside leverage. Sort of like where we're kind of in this strange market condition right now where the market doesn't know what it wants to do. We are going into a holiday season, so it very well may break out, especially coming out of this going into 2026. You may start seeing a bullish market coming out. So potentially now is a good time to buy what I call value stocks. And that's it. So let's get into the practical part of it. Here we have our Thinkorswim app. It is opened up. And basically, I'm in the trade window and I have Walmart selected. The ticker symbol is Walmart, WMT. This is the option chain here, all these legs. And like it says, you want to look out potentially, 30 to 90 days and so forth. I like to look all the way out. This thing goes all the way out to January 2028. If you can see that highlighted in white, January 21 of 2028. So, however, if we looked according to, my notes here, it says, look, 90 days or so forth, we got 79, 20. So let's look at 20 March 2026. We're going to open up that option chain or that leg. This side over here is called the puts. We're not paying attention to the puts. We're just going to go ahead and pay attention to our call side, which is here, just our call options. The strike price, as mentioned, is what the stock price used to be. So at one point, Walmart was trading at $45. And as you can see, it's highlighted here. The lavender or bluish highlight that's over here is stocks or options that are in the money. These are in the money. This $45 is a deep in the money contract. Anything close to the stock price right now, it's $1.13, $113. We're looking at, if anything is trading at this price, it's considered at the money. Anything less than that is considered in the money. And anything out of that, out past the 113 is considered out of the money. As this 115 is considered out of the money. The 110, close. There's no 113, so there's no at the money contract right now. So we're either in the money at 110 or out of the money at 115. And as you can see here, the ask price or the premium, this is what they mean about your premium. Your premium is your ask price. the price you're going to pay for it. And what you have to remember is each contract, every single contract, one contract has 100 shares. Each contract has 100 shares. So, for example, if we're looking at this out of the money 115 contract, which expires on 20 March 2026, the ask price or the premium price is $5.80. If you break open your calculator and you multiply that times 100, that's $580. $580 to control this one contract. And what you would do, you would just click on that. This window will pop up. This is, again, the Thinkorswim platform. There's a few things you want to check when you do that. You want to go here and make sure you do want to purchase 5 contracts. This is the default out. You can set the default to 1, 2, whatever contracts you want to buy. However, for this lesson, we're just going to go ahead and select just one contract. It's going to be a single contract. We're buying it, right? It's a buy, not a sell. We're buying one contract, which has 100 shares. I normally leave it on auto. However, I want to just highlight this window. And because we're doing a buy to open, we're buying this contract to open. So you can leave it on auto if you want to, or you can come here and just select to open, buy to open. You want to make sure that you're purchasing Walmart. Just doing some quick checks. The expiration is going to be 20 March 2026. The strike price or the stock price that you're thinking Walmart's going to get to eventually is $1.15 or $115. You're willing to pay, all right? It's a call. So you're saying the stock is going to go up. You're bullish. And you're saying that the premium price or the strike price you're willing to pay is $5.80, which times 100 is $580. And that is your limit, right? That is your limit. It's going to be a limit order. I normally like to leave it, especially if I'm doing a new order and I'm excited about it. I want it to get in there because as you can see here, the ask price is $1.14. So what I want to do here is come and I'll just go good till close. That normally gives me about 60 days or so for this to be filled. If I want to walk away, I got some things, my life is too busy and I want to walk away from it. This good till close will more than likely guarantee this purchase here. So you're going to come down, you're going to select the best exchange. I normally just leave it at the best and just go ahead and hit confirm and send. And this window opens up and it says buy one Walmart contract. It's 100 shares in there. You're going to multiply that times your 580. Your break-even stock price is going to be $120.80. Your max profit is infinite. Your max loss is $580. The cost of the trade is going to be your $580 plus your 65 cents in commission fees. Your buying power effect after that is going to be minus $580. So whatever is remaining. This is a Thinkorswim trading platform, you can use to practice before you actually start trading. So it's saying that you have a remainder, a little over $109,000 left to purchase more shares of options or stocks or whatever you want to purchase inside. You want to make sure that you're selecting the right account, either you're pulling it from your margin account or your IRA. Let's go ahead and IRA, even though this is fake money. This is a single account, not multiple accounts and so forth. And then you just hit send. You press the send button and this window will pop up. It'll let you know you have a position inside this leg here. So once Walmart goes up in stock price, starts to go up, you're going to see this premium or this ask price also go up. And that is the power of an option. You can buy this option for $5.80 today and come back in 60 days or 90 days, and the price might be here. Your premium might change to $30 because now the stock has gone up appreciably. And that's where you would go back in and you would basically sell to close the contract and collect your 580 back plus the gains that it has made in the market. We'll go ahead and do another one, another leg. Let's look all the way out to January of 28. Again, the deeper you go in the money contracts, the more it's going to cost. I typically stay away from those. Those are long gone. I typically want to look out, and the further more you look out of the money, that's speculation. You're basically gambling with your money. Then you're saying, well, it's cheaper. I can afford it. But now you're speculating because if Walmart pulls back, you could potentially be assigned, and you don't want to be assigned, meaning the stocks will be deposited in your account. So we get here and we look all the way out. Again, the 115 that did cost us $580 because it has so much time to potentially make it to 115 by 2028. That's now going to cost you $1,960. Again, we're going to come here, single buy, make sure we adjust for the one contract. We're going to buy to open, check our symbol, check the expiration, check the strike price, make sure it's a call, not a put. And let's check the price that we want to pay. And we're going to hit send. It's going to tell you your break-even stock price, your max profit, but it's going to cost you to do this $1,960 plus commission and what's remaining after. Then you can just come here and hit send. So the wonderful thing about options is it allows you the freedom to lock in a certain amount of loss. And what I mean by that is if you were to purchase the stock outright, your loss can be, all of your stocks can go down to zero. That is why you choose value stocks. You do not choose stocks that are over the counter or high risk. You want to limit your stock. You want to go into stocks that have proven themselves, that have value. Their balance sheets are really good. Their fundamentals are very stable, and they have a right to be trading at the price that they're paying for, trading at. So you want to stick with those. However, once they'll come down, like in a bearish market where we're sort of in right now, they call those value stocks. They'll pull back a little bit, not because of their management of the company. It's just because of the condition that the market's in right now. So you want to take an opportunity of that and purchase these value stocks utilizing options if you do not have the leverage to buy them outright. And what do I mean by that is if you were to purchase outright 100 shares of Walmart at this price at $115, I'm going to break open the trusty calculator. So $115 by 100 shares, that same trade will cost you $11,500 to control 100 shares. However, when you do it in the option way and you're buying it's expiring in 2026, instead of $11,500, you just got to use $580 to control the same amount of shares. The difference is this expires. It expires. It's the only difference. Hopefully, this makes sense to you. Come back and watch this video. And that's pretty much it. I can't make it any more simpler than that. I don't want to overwhelm you with too many terminologies. But that is pretty much it, folks. That is options in a nutshell. That is options in a nutshell. Or in this case, long options. Right? So hopefully you guys have picked something up and you can start putting it in practice. Definitely utilize, if you have Charles Schwab, use the Thinkorswim app. I believe E-Trade has one. So does Investopedia. I don't know about Seeking Alpha. I believe Robinhood has one as well. And just check with your brokerage account or firm if they have a Thinkorswim app similar or platform similar to Charles Schwab, which they purchased from TD Ameritrade. And just use it. Use it before you lose your money. Practice, practice, practice. Practice makes perfect. And then once you're ready, just go ahead and utilize your knowledge. So learn, do your due diligence, and become profitable. This is Mark Gordon from Mag Weegis, and I hope this lesson provided some insight.